The chapter number 7 of our macroeconomics, aggregate demand and related concepts, has three important concepts: the consumption function, which we have already discussed, the saving function, which again we have discussed, and the third one is the investment function. The third category is the investment function. Under investment function, we are going to discuss certain important things. The first one is that the difference between induced and autonomous investment. We'll be speaking about the two determinants of investment, which is marginal efficiency of investment and rate of interest. And finally, we'll conclude this section by talking about two very important economic terms, ex ante and ex post. We have already said that in economics, when we are talking about planning, we are talking about the term ex ante and not of ex post. So we'll be discussing this in detail. So we begin with the discussion of the term autonomous investment. If we use this graph for explanation of autonomous investment, the concept will become very easy. Let's check out on this graph what is shown. So if we look at this graph, on the x-axis we have depicted income, and on the y-axis we have shown the changes in investment. Our investment curve is a line which is parallel to the x-axis. So what is the importance of this investment curve being parallel to the x-axis? If we see when the income is changing, when your income was OY, investment was MY. If investment increases to OY1, still the income continues to be the same. So any changes in income is not bringing about change in investment. This is what this autonomous investment curve is showing. So this, if the income reduces to suppose OY2, still our investment continues to be the same. So how do we define autonomous investment? Autonomous investment means that investment which is not affected by changes in the level of income, or in other words we can say that it is independent of the level of income. This is what is autonomous investment. And who makes this autonomous investment? It is generally the government who invests on infrastructure activities in order to develop the country. So the level of autonomous investment depends upon three major factors. The first one is the social factors, second one is the economic factor, and the third one is the political condition of a place. And this autonomous investment might change due to changes in technology, or it can change because new resources are discovered, or it may change on account of growth of population. This autonomous investment is income inelastic. We've just explained by means of the graph that any change in income, whether increase or decrease, is not causing a change in autonomous investment. That's the reason why we say that it is income inelastic. It is not influenced by changes in income. And how do we show this autonomous investment? It is shown by a line which is parallel to the x-axis. So that shows that the income is changing, but there is no change in investment. It continues to be the same. Now let's speak about the difference between induced investment and autonomous investment. The difference between the two is, we have done the graph earlier about induced investment. So the induced investment graph is, you have the income on the x-axis and you have investment on the y-axis, and an induced investment graph is a graph which is an upward sloping curve, unlike the autonomous investment graph, which is a line parallel to the x-axis, which we just done very shortly. This is the autonomous investment graph. Now, what is the difference between the two? Just by looking at the graph, we can see that in case of induced investment, the investment is a function of income. More the income, higher will be the investment. See, if income is y, OY, investment is OI. If income changes to OY1, which means investment has increased, unlike over here, the investment continues to be the same irrespective of the level of income. Clear? The second thing, it's just a repetition. In case of autonomous investment, it is done by the government, so it is for social welfare purposes. Induced investment is for the purpose of earning profit. Induced income is income elastic. That means small changes in income, whether increase or decrease, will cause a change in investment. But autonomous investment is income inelastic, meaning any change in income any change in income, there won't be any change in the autonomous investment. It will continue to be the same, which is shown by the line which is parallel to the x-axis. Now, talking about the curves of induced investment and autonomous investment, we just drew the graph and we showed that the induced investment curve is a line which slopes upwards, and autonomous investment curve is a line which is parallel to the x-axis. And induced investment, the first statement itself shows that induced investment is done by the private sector, and when we say social welfare, that means autonomous investment is done by the government sector. With this, we move on to the Keynes theory of investment, who said that the decision whether to invest in a new project or not to invest in a new project depends upon two things. The first one being the marginal efficiency of investment. And how do we define marginal efficiency of investment? Marginal efficiency of investment means how much is the expected return from an additional investment. How much is the expected return on an additional investment? Okay, marginal word itself says additional, so efficiency of investment meaning how much returns would be expected from any additional investment, and it is dependent upon two things. One is the supply price and the second one is the prospective yield. To explain what is supply price, it is the cost of producing a new asset of that kind and price at which the new capital asset can be supplied or replaced. This is what is the supply price. What is the prospective yield? It is the net return expected from the capital asset over its lifetime. So how much you are going to expect, how much you expect from a particular capital asset over the lifetime is what is the prospective. We can take an example to explain what is the supply price. So if you have a machine and you buy a machine which costs about 5,000 rupees, and the old machine was replaced by this new machine, so the supply price is 5,000 rupees. Taking an example to explain prospective yield, suppose the machine which you have bought for 5,000 rupees, it gives you a yield of about 1,200 rupees, and you spend about 200 rupees on running expenses. So the prospective yield from the machine is 1,000. So now if you have to calculate the marginal efficiency of investment, you write down the prospective yield, which is 1000. Supply price was 5000 into 100. Cutting these zeros, what we get is 5 ones are 5, 5 twos are 20. So 20% is the marginal efficiency of investment. The second factor which determines the investment is the rate of interest. And its rate of interest is basically explaining the cost of borrowing and using that money for investment. And we must remember that cost of borrowing is inversely related to the rate of interest. Higher the rate of interest, higher will be the cost of borrowing, and people will invest less. Investment will be less. And rate of interest is less, then cost of borrowing will be less. So investment will be more. So the two determinants of investment are marginal efficiency of investment. Under this you have to learn about supply price. Under this you have to learn about prospective yield, how to calculate the marginal efficiency of investment, that is prospective yield upon supply price into 100, and explain the relationship between cost of borrowing and rate of interest, when investment will be more, when rate of interest is less, and investment will be less when rate of interest is more. How to calculate the profitability of investment? The profitability of investment will be worked out by comparing the marginal efficiency of investment and the rate of interest. As long as the MEI is more than ROI, that is, the investment will continue to happen. So you have to keep comparing the marginal efficiency of investment and the rate of interest. So as long as MEI is greater than the rate of interest, then it is profitable and more investment will be made. And second case is, if the marginal efficiency of investment is less than the rate of interest, then it is not profitable. So the investments have to be reduced. So this increase and decrease will keep on happening till the equilibrium is reached, where the marginal efficiency of investment is equal to the rate of interest. So comparison between MEI, that is marginal efficiency of investment, and rate of interest will determine the equilibrium, when to stop the investment. There are two aspects of savings and investment in our economy. The first one is ex ante, that is planned investment and savings. Under this ex ante, we'll be speaking about ex ante savings and ex ante investment. The second category is, we'll be talking about ex post, which is a sum of planned and unplanned. And under this, we'll be explaining savings, ex post savings, and ex post investment. So now let us explain the terms ex ante savings and ex ante investment first. So what is ex ante savings? Ex ante savings refers to the amount of savings which household and savers plan to save at different levels of income in the economy. What is important in this context is the word planned. These are planned savings which households and savers are planning to save in an economy, and this amount of planned saving is given by the saving function or propensity to save, which we have already discussed. So what is ex ante investment? It refers to the investment which firms plan to invest at different levels of income. Please remember, in both the cases the word plan is there. The difference over here is, here the households are going to do the savings, and here the investment is to be done by the firms, and it is determined between it is determined by the relationship between investment demand and rate of interest, which we have will be shortly discussing about it. So the two components are of ex ante are ex ante savings and ex ante investment. Savings are done by the household and investment is done by the firms. So let's talk about how is equilibrium determined in the economy. Equilibrium in the economy is determined at the point where ex ante savings is equal to ex ante investment, talking about again and stressing the fact that ex ante refers to planned savings and ex ante investment refers to planned investment. So equilibrium is determined at the point where these planned savings is equal to planned investment. So both these concepts are equal at equilibrium level of income. So what are the conditions which are necessary for this to happen? What to happen? The ex ante savings to be equal to ex ante investment. First thing, as we discussed very shortly now, that saving is done by household and investment is done by firms. This is the first thing which has condition which needs to be fulfilled. Then the second thing is saver is a different person and investor is a different person, and both these people have different priorities in life. So this is the second condition which needs to be fulfilled in order that this ex ante savings be equal to ex ante investment. And the third one is savings as maintenance amount and investment will be made in small amounts, and investment will be made in big amounts, because saving is done by households. So the saving will be in small amounts, whereas investment is done by firms. So investment will be in big amounts. The next thing is saving is made for future needs and investment is made for making profit for the firms. So when we are saving, we are saving for our future uncertain needs, but when investment is being done, it is being done by the firms in order to get maximum profit. So all these four conditions need to be fulfilled in order for this to operate. That is, ex ante saving should be equal to ex ante investment. Now we will be explaining the term ex post, and as we introduced the topic, we said that we will be speaking of ex ante savings and ex ante investment. Similarly, we will be speaking about ex post saving and ex post investment. So what is ex post saving? Ex post means planned, which means actual or realized savings in an economy during a financial year. So it is a sum of planned saving as well as unplanned saving. What is actually realized? So it is a sum of planned saving and unplanned saving in a financial year. What is ex post investment? Ex post investment, also the terms will remain the same. It refers to actual or realized investment during a year. So it is also a sum of planned investment and unplanned investment. It is a sum of planned investment and unplanned investment will give us ex post investment. So ex post savings will be equal to ex post income at all the levels of income, and this equality between the two is brought by fluctuations in the income. So to briefly conclude the lesson, we spoke about induced investment and autonomous investment. We tried to understand the graphs which are related to these investments. Induced investment is an upward sloping curve. Autonomous investment curve is a line parallel to x-axis showing no change in investment on account of changes in income. Then we went on to discuss the determinants of investment. Under determinants of investment, we spoke about the marginal efficiency of investment, which itself is determinant of the supply price and the prospective yield. And then with the help of prospective yield and supply price, we calculated the marginal efficiency of investment, prospective yield divided by supply price into 100, and the rate of interest. We said that the cost of borrowing and the rate of interest are inversely proportional. So if the rate of interest is high, the cost of borrowing also becomes high, so investment will be less, and vice versa. To conclude this part, we spoke about ex ante saving and investment, which is planned saving and investment. In economics, we are generally referring to the term ex ante. And then we spoke about ex post savings and investment. Under ex post savings, we said that these are actual and realized savings or investment, which is a sum of planned savings and unplanned savings, or planned investment and unplanned investment. We also said that the equilibrium will be determined at a point where marginal efficiency of investment is equal to rate of interest. That means investment will continue till this equilibrium is not achieved. The moment this equilibrium is disturbed, then either the investment will be increased or investment will be decreased, depending upon whether marginal efficiency of investment is greater than the rate of interest or marginal efficiency of investment is less than the rate of interest.